You know, usually when you go to the supermarket and you pick up a box, right, and it's labeled cereal, you expect to actually find cereal inside.
Right. Yeah, you don't open it at the breakfast table and find, like, a power drill.
Exactly, because we rely on those basic labeling categories to make quick, safe decisions. A label is just, it's supposed to be a shortcut for trust.
Yeah, the social contract is pretty fundamental.
But when you step into the world of high finance, specifically India's newest regulatory creation, that contract is completely thrown out the window.
Oh, absolutely out the window.
We are looking at a financial product where the label on the box might have, absolutely nothing to do with the actual risk you are taking on inside.
It's hiding some truly wild variations behind a very boring bureaucratic name.
Right. So, welcome to today's deep dive. We are exploring the explosive, frankly mind-boggling growth of India's newly regulated investment vehicle. They're called Specialized Investment Funds, or SIFs.
Yeah, and we're talking about a 23,177 crore industry here.
Which has grown by an astonishing 370% in just 7 months. So today, our mission is to cut through the heavy financial jargon. We've been looking at a massive intelligence brief from PMS AIF Leap, alongside some really brilliant teardowns by financial expert Curtin Shaw.
Who really breaks down what this industry actually is? Why the money's moving so fast, and how to look past the shiny marketing.
Because, spoiler alert, the story the marketing brochures are telling you and the reality the data reveals are, they're two completely different narratives.
Totally different.
Okay, let's unpack this. To understand why a SIF even exists, we have to look at the massive systemic problem the market regulator SEBI was desperately trying to solve.
Right, the origin story.
Yeah, they were watching retail investors get absolutely crushed in the derivatives market, specifically futures and options, F&O.
And the scale of the wealth destruction is just staggering. I mean, SEBI's own studies found that 93% of individual retail traders in F&O lost money.
93%?
Yeah. In just the 2026 financial year, the aggregate individual losses hit 91,685 crore.
Wow.
That is an astronomical amount of middle-class wealth just, evaporating from retail brokerage accounts.
And options alone accounted for about 92% of that damage, which, it makes sense when you think about the mechanics of an option.
Exactly.
When a retail trader buys an option on their phone, they aren't just betting on whether a stock will go up or down. They're fighting against a ticking clock.
Time is literally the enemy there.
Right. Options have an expiration date. So the underlying asset has to move in the right direction by the right amount within a very specific time frame. Time decay it eats away at their premium every single day.
What's fascinating here is that this is a mathematical reality that professional money managers understand deeply. But amateur traders often just ignore it in favor of chasing leverage.
They just see the potential upside.
Yeah. So the regulator looked at this landscape and saw a structural gap. On one end of the spectrum, you have traditional mutual funds.
Right. Highly regulated, safe, accessible for just $100.
But a mutual fund can only use derivatives for hedging. If the broader market crashes, a traditional equity mutual fund is going down with it. They are legally prohibited from taking a naked, unhedged short position to profit from a market drop.
So a mutual fund is essentially trapped on the long side. If you want a manager who can aggressively bet against the market, you traditionally have to go to the other extreme, which is portfolio management services, or PMS.
Right, the walled garden.
Exactly. Those platforms allow for sophisticated derivative strategies, including unhedged shorting, but they require a massive 50 lakh minimum investment. It's for the ultra-wealthy.
Leaving the everyday investor who wants to trade aggressive F&O with only one option, which is to do it yourself on a smartphone app.
And as we saw, 93% of the time, that ends in disaster.
So SEFs were notified in February 2025 to sit perfectly in the middle of this gap.
Okay.
They lowered the minimum investment floor to 10 lakh. And their superpower, really, is that they allow the fund manager to hold up to 25% of the portfolio in unhedged short derivatives.
So they can actively bet against the market, just like a PMS, but at a fifth of the entry price.
Exactly.
To me, it feels like SEBI essentially built a pressure valve. They know they can't entirely stop the retail public from gambling on F&O. The appetite for leverage and complex trading it's too ingrained now.
Oh, completely.
So instead of outright banning it, they are trying to channel all that dangerous, explosive retail pressure into a professionally managed pipe. But just because a professional is driving the car, does that actually make unhedged shorting safe?
Well, that structural shift is the entire point. It doesn't eliminate the risk of the underlying instrument, but it completely removes the behavioral risk.
Panic selling.
Right. The amateur trader is no longer panic selling at the bottom or over-leveraging their account. And SEBI put strict guardrails on the professionals, too. SEF managers cannot use leverage through derivatives to borrow money they don't have.
Okay, so there's a limit.
Yeah, their gross exposure is strictly capped at 100% of their net asset value. If the fund has a learn 100 in total assets, their total market bets cannot exceed even 100.
Okay, so you get professional drivers, but SEBI put a speed limiter on the engine.
That's a good way to put it, yeah.
If we move from the origin story into the actual machinery, a SIF operates very differently from a mutual fund or a PMS account, right?
Okay.
Especially when it comes to taxes. There's this massive taxation and liquidity trade-off happening under the hood.
Oh, the tax structure is arguably the most advantageous feature for a savvy capital allocator. It all comes down to eliminating the tax drag caused by portfolio churn.
Which is huge over time.
Yeah. Exactly. If you hold a traditional PMS for a decade, your portfolio manager is actively buying and selling stocks to optimize your returns. But every time they sell a stock at a profit, you take a direct capital gains tax hit. Ouch. Yeah, capital is constantly being siphoned out of your account to pay the government, which severely diminishes your ability to compound your wealth over time.
I always visualize this like trying to do a massive real estate flip.
Okay, how so?
Like if you do it normally, you're paying taxes on every little transaction every time you buy paint, hire a plumber, or sell scrap material.
Right, that adds up.
But SFs operate under the mutual fund framework, specifically Section 1023D. So it's like putting that entire real estate project inside a tax-exempt trust. The internal churn is just invisible to the taxman.
Yes. The fund manager can buy and sell 1,000 times to execute these complex derivative strategies, and there is zero tax implication at the fund level.
You only pay the tax when you sell the entire completed house, meaning when you redeem your units and exit the fund.
Keeping that capital intact to compound internally without tax leakage is a profound mathematical advantage over a 10-year horizon. But, and there's a big but, liquidity is the currency you are trading away to access those sophisticated strategies and tax benefits.
And this is a massive shock to the system for anyone used to mutual funds. I mean, usually you click sell on your brokerage app and the cash hits your bank account in a day or two.
SIFs operate in a completely different reality. Even equity SIFs, which might offer daily liquidity in theory, are legally permitted to impose a notice period of up to 15 working days for redemptions.
15 working days.
And if you are in a hybrid or debt SIF, the friction is even higher. They operate on an interval basis, meaning they might only open the window to process redemptions once or twice a week.
A 15 working day notice period is basically 3 calendar weeks. You tell the fund you want out, but your money remains fully exposed to the market's ups and downs for nearly a month before they actually liquidate your position and hand you the cash.
The fund managers require that runway because unwinding complex derivative positions, especially spread strategies or illiquid option contracts, it just cannot always be done overnight without taking a massive loss on the bid-ask spread.
Right. That makes sense from their side.
And compounding that liquidity trap is the rule surrounding the 10 lakh minimum balance.
Oh yeah, let's talk about that. That ERA lack isn't just an entry ticket to get through the door.
Not at all. It is a permanent floor. The regulation states you must maintain 10 lakh per investor at the PAN card level across all SIF strategies of a single asset management company.
Wait, so I can't just pull out a little cash if I need it?
You cannot partially redeem your funds if that redemption drops your residual balance below that 10 lakh mark. If an emergency hits and you need to pull out 2 lakh from a 10 lakh account, you're forced to liquidate the entire position and close the account completely.
Wow. If the exit doors are that heavy and the friction is that high, you'd logically assume investors are only using these funds for massive, high-risk equity bets where the potential payoff actually justifies locking up your money.
You would think so.
But the data from the sources shows the exact opposite.
It really does. The divergence between the aggressive marketing narrative and the actual investor behavior is fascinating. The brochures pitch SEFs as high-octane equity long-short vehicles. Yet when you look at the industry totals, 71.3% of the entire assets under management, which is 16,524 crore, is parked strictly in hybrid strategies.
That's a huge majority.
Yeah, and if you isolate just the net flows for July 2026, 70.5% of the fresh money rushed straight into the hybrid bucket.
Here's where it gets really interesting. SEBI actually created categories for pure debt long-short funds too. But as of July 2026, the data shows zero schemes, zero folios, and zero AUM in the debt categories. They are literally dead on arrival.
Completely empty.
Yeah, every ounce of fixed income appetite is being routed through that hybrid bucket.
If we connect this to the bigger picture, you can see the true intent of the investors simply by looking at the average ticket sizes.
Oh, the ticket sizes are telling.
Very. The implied AUM per folio for the Equity X Top 100 strategy, which focuses on stocks outside the biggest 100 blue-chip companies, is about 14.2 lakh. It's hovering very close to that Euro lakh regulatory minimum.
Just dipping their toes in.
Exactly. But the average ticket size for the hybrid long-short category is 36.9 lakh per folio.
Meaning the largest checks in the entire ecosystem are being written into the strategies that are theoretically the most conservative. High net worth individuals aren't using SIFs to swing for the fences with naked equity shorts.
No, not at all.
They are deploying significant capital to generate steady, tax-efficient, fixed-income adjacent yield.
It is a brilliant example of highly rational capital adapting a regulatory tool for its own needs. SEBI built a product to absorb the high-risk retail gambler, and the wealthiest investors immediately utilized it as a sophisticated, tax-sheltered savings alternative.
Which is smart, but this overwhelming rush of capital into the hybrid bucket brings us to the most dangerous aspect of the SIF landscape, because the label hybrid long-short is incredibly misleading.
It is dangerously broad.
Going back to our supermarket aisle analogy earlier, if you walk down the aisle marked hybrid SIF, you naturally assume everything on that shelf is roughly the same product.
Right.
I mean, if I buy an SBI large cap mutual fund or an ICICI large cap mutual fund, the underlying mechanics are virtually identical. The funds are legally bound to put 80% of my money into the top 100 stocks. You know what you're getting.
The variance in traditional mutual funds is tight. But in the SIF world, putting two funds into the same regulatory category tells you almost nothing about the risk you're actually taking.
Nothing at all.
Let's examine the extreme dispersion happening right now within just the hybrid long-short category.
Okay, lay it out.
On one end of the spectrum, you have Altiva, managed by Edelweiss. It has a stated SEBI risk band of level 1. It operates a spread strategy, which means it relies heavily on cash future arbitrage.
And for anyone unfamiliar with cash future arbitrage, the mechanics are actually quite conservative. The manager buys a stock in the regular cash market and simultaneously sells the futures contract for that exact same stock, which is usually priced slightly higher.
Right, locking it in.
Yeah, they are just clipping that tiny price difference, the spread. They aren't predicting if the overall market will boom or crash. They've mathematically locked in that tiny profit regardless of market direction.
Which is why Altiva's volatility is a tiny 3.29%. It is designed to be a smooth, stable ride. Now contrast that with ISIF, managed by ICICI Prudential.
Okay.
It sits in the exact same hybrid long-short regulatory category.
Right.
But its risk band is level 5, the absolute highest risk rating for potential capital loss.
Level 5 in the same category as level 1.
Exactly. Unlike Altiva, ISIF takes directional, unhedged shorts using options and futures. They're actively analyzing the market, predicting it will drop, and placing leveraged bets on that outcome. If they guess wrong, the fund takes a direct hit.
Which explains why ISIF's volatility is a massive 12.91%. That is nearly a 4x difference in volatility between two products sitting in the exact same regulatory box.
It's massive.
It really is like ordering a beverage and having no idea if the waiter is handing you a glass of water or a shot of tequila.
That's a perfect analogy. And this happens because the regulation only mandates what asset classes a hybrid SIF must hold, which is a minimum of 25% equity and a minimum of 25% debt.
But the rest is up to them.
Yeah, it gives the fund manager near total freedom on how they deploy the remaining 50% of the capital and how aggressively they utilize their 25% derivative allowance.
And this dispersion isn't just theoretical math. The sources highlight exactly how this played out during the minor market correction in March 2026.
So the drawdown data is telling. Look at the maximum drawdowns during that period. Aruda, managed by Ben Han, runs a net zero equity strategy. Its maximum drawdown during the correction was just minus 0.24%.
Barely a scratch.
Right, it recovered fully in just 7 calendar days. It essentially glided over the bump. Meanwhile, the little 5 funds in the same category took heavy damage. ISIF fell minus 8.95% and took 79 calendar days, which is 53 actual trading days, just to climb back to zero.
Wow.
And titanium, managed by Tata, fell 7.47%.
So if all the smart money is crowding into the hybrid aisle, strategy-level diligence is the only thing that matters. You literally have to lift the hood on every single fund. And the danger of assuming all hybrid SIFs are the same extends directly to your tax bill as well.
Oh, the taxation rules for holding periods under 12 months are incredibly complex here.
Let's get into that.
Well, we established that long-term capital gains holding for more than 12 months is a uniform 12.5% across the board. But if you need your money back in less than a year, your tax rate depends entirely on the specific internal asset mix the fund manager chose to run.
Okay, let's trace the mechanics of that. If I buy Magnum, which is SBI's fund, and I am forced to sell it in, say, 11 months, what happens?
Magnum qualifies as an equity-oriented scheme. To get that status, the fund's specific algorithmic mix of physical domestic equities and arbitrage positions must meet a certain threshold. Because it hits that mark, your short-term gains will be taxed at a flat 20%.
Okay, 20%. But if I had bought Infinity by Kotak, which again is sitting in the exact same hybrid long-short category, and sold it in 11 months...
Infinity's internal mechanics do not meet the equity-oriented threshold, so the tax code treats it as a debt-oriented scheme for short-term gains.
Oh, no.
Yeah, therefore, your profits are simply added to your total income for the year and taxed at your personal income tax slab rate. If you are a high net worth individual in the highest tax bracket, you are suddenly paying over 30% in taxes.
That is wild. Two funds marketed side by side with identical regulatory labels, but one gives you a 20% tax bill and the other hits you with a 30+% tax bill if you need to exit early.
It's a huge difference.
It really reinforces the idea that SIFs heavily penalize investors who don't read the fine print, and they severely penalize investors who change their minds quickly.
This raises an important question, though. Given that the category labels are practically useless, and the risk profiles are all over the map, how does an investor actually measure if a specific SIF is worth their capital?
So what does this all mean for evaluation?
Well, the first step is totally counterintuitive. You have to completely ignore the absolute return tables.
Which is usually the very first column an investor looks at. We are so conditioned to just rank funds by their one-year return.
In a mature category, that makes sense. But the SIF category is incredibly nascent, which means the inception dates vary wildly. Altiva launched in October 2025, Platinum launched in June 2026.
Right.
If you compare a 10% return on an older fund to a 6% return on a newer one, you aren't evaluating manager skill or strategy strength. You are literally just comparing calendars. The funds have been exposed to entirely different market conditions.
So if we throw out the absolute return table, the sources suggest a much more analytical sequence. You start by reading the AMC's stated risk band. Is it a level 1 or a level 5? You match that to your personal sleep-at-night threshold.
Exactly.
But a risk band is just a marketing claim. To prove if they're actually living up to that claim, you have to look at the standard deviation, or volatility. You're checking if a fund claiming to be level 1 is actually keeping its daily price swings down near 2 or 3%.
Standard deviation measures the actual bumpiness of the ride. A fund could average a 10% return, but if its standard deviation is 12%, the swings are so violent that you can easily find your portfolio in negative territory depending on the day you check it.
So if you are analyzing a fund that has a high standard deviation, that naturally leads you to the most critical metric for SIFs, which is the Sharpe ratio.
Yes, the Sharpe ratio is key here.
I always view the Sharpe ratio as a tool that asks a very simple question. Is this roller coaster ride actually buying you a better view? Are you, the investor, getting adequately compensated with excess returns for enduring that stomach-churning volatility?
That is the exact mathematical function of the Sharpe ratio. It measures efficiency. If a fund took massive directional risks to generate a slightly better return, the math will expose it with a low Sharpe ratio.
Okay, and if they kept risks low?
If a fund kept risks tightly controlled but still generated steady, reliable returns, it will boast a high Sharpe ratio. For context within this early cohort, Edelweiss's Altiva currently holds the highest Sharpe ratio at 2.25. They're delivering highly efficient returns relative to the minimal risk they are taking on.
And the final piece of the evaluation puzzle is matching your investment horizon to the specific strategy mechanics. The guidance from the sources here is absolute. You do not touch equity SIFs unless you have a minimum 5-year time horizon.
Right, 5 years minimum for equity.
For hybrid SIFs, if it's an arbitrage-heavy fund like Altiva clipping spreads, you need a minimum 18-month runway.
But if you're looking at a dynamic balance advantage equivalent like iSIF or titanium, The horizon stretches to at least 36 months.
That long.
Yeah, because those managers are actively shifting capital between equity and debt based on complex market valuation models. They are buying low and selling high across entire asset classes, which inherently requires a full 3-year market cycle to actually execute and bear fruit.
Okay, to pull all these threads together, SIFs represent a genuinely incredible financial innovation. SIBI has successfully engineered a powerful new tool to address the retail F&O crisis, offering tax-efficient, professional derivative management.
Absolutely, it's a game changer.
If you are sitting on 10 lakh or more and you want to optimize your portfolio beyond traditional mutual funds, SIFs offer you a very sharp scalpel.
But a scalpel is dangerous if you don't know how to hold it. These products demand an immense amount of due diligence. You cannot buy a SIF based on its name, its regulatory category, or a single month's return.
It is absolutely not a product for lazy capital. Which brings me to a final thought I want to leave you with. Something to mull over that goes beyond the current data. Our sources note that SEFs haven't actually faced a sustained long-term market crash yet.
No, they haven't.
Sure, a few of them weathered that minor bump in March 2026, but many of the hybrid funds launched well after that. They are completely untested in a real, prolonged crisis.
The true structural integrity of any financial product is only revealed when everyone rushes for the exit at the exact same time.
Think about the psychological impact when the next massive market shock hits. Retail investors in India have been deeply conditioned for the instant gratification of mutual funds. You panic, you hit sell on your app, you get your cash in 2 days.
That's the muscle memory.
Right. But what happens to market dynamics and to investor sanity when tens of thousands of investors suddenly realize their capital is firmly locked behind a 15-day notice period?
It's going to be wild to watch.
Will that massive friction act as a brilliant stabilizer, preventing a knee-jerk market crash by physically forcing people to hold on? Or will it create a terrifying bottleneck, trapping investors in a burning building while fund managers frantically try to unwind complex, leveraged derivative positions? Only time and the next bear market will tell.